Welcome to the Wealthfinity channel. Are you looking to maximize your tax deductions as a homeowner? Look no further, because we have the complete guide to deducting mortgage interest. In this series, we'll provide you with a comprehensive overview of everything you need to know to make the most of your mortgage interest deduction and keep more money in your pocket. Stay tuned and join us on this journey to financial freedom. Mortgage interest is one of the largest expenses for most homeowners, and it can also be a significant tax deduction. However, it's essential to understand the rules and restrictions surrounding mortgage interest deductions to maximize your tax savings. In this video, we will take a closer look at how much of your mortgage interest you can expect to deduct and what you need to know to make the most of this tax benefit. First, let's look at the basic rules for deducting mortgage interest. To be eligible for the mortgage interest deduction, you must have a mortgage on a qualifying home. This includes your primary residence, as well as a second home or vacation home. The mortgage must be used to buy, build, or improve the home. In addition, the loan must be secured by the home and must meet certain other criteria established by the Internal Revenue Service, IRS. It's important to note that mortgage interest deductions are limited to the interest paid on the first mortgage. Any interest paid on a second mortgage, home equity line of credit, or other loan secured by the home is not eligible for the mortgage interest deduction. Mortgage interest can be a significant tax deduction for homeowners, but it's essential to understand the rules and restrictions surrounding this deduction. By knowing how much of your mortgage interest you can expect to deduct, you can take advantage of this tax benefit and lower your overall tax liability. If you have any questions or need further guidance, it's recommended that you consult with a tax professional to ensure that you maximize your tax savings. A mortgage interest deduction is a tax benefit that allows homeowners to deduct the interest paid on their mortgage from their taxable income. In other words, it reduces the amount of taxable income that a homeowner must report to the government. This benefit is only available to homeowners who itemize their deductions on their tax returns, which means that they cannot take the standard deduction. The amount of mortgage interest that can be claimed as a deduction varies depending on several factors, including the type of mortgage, the amount of the mortgage, and the tax laws in place at the time the mortgage was taken out. For mortgages taken out before December 15, 2017, homeowners can deduct the interest paid on mortgage debt up to $1 million for their primary residence. For mortgages taken out after December 15, 2017, the limit is reduced to $750,000 for primary residences. For second homes or investment properties, the limit is still $1 million for mortgages taken out before December 15, 2017, but it is now $750,000 for mortgages taken out after that date. It is important to note that not all mortgage interest is deductible. For example, interest paid on home equity loans or lines of credit is not deductible unless the loan is used to improve the home. In addition, mortgage insurance premiums are not deductible. In general, the mortgage interest deduction is a useful tool for reducing taxable income and allowing homeowners to keep more of their hard-earned money. However, it is important to consult a tax professional to determine whether it is the best option for your individual situation. A guide to calculating your tax-deductible mortgage interest. As a homeowner, you may be eligible to deduct the mortgage interest you pay on your tax return. This can lead to significant savings and is a great way to lower your overall tax bill. But how do you calculate your tax-deductible mortgage interest? In this guide, we'll walk you through the process and help you determine how much you can claim. Step 1. Determine if you're eligible. The first step in calculating your tax-deductible mortgage interest is to determine if you're eligible. To be eligible, you must be the homeowner and the mortgage must be for your primary residence. Additionally, the mortgage must have been taken out after December 15, 2017, and the mortgage debt must be less than $750,000 for married taxpayers filing jointly and $375,000 for those filing separately. Step 2. Find your mortgage interest statement. Your mortgage interest statement, Form 1098, will show the total amount of mortgage interest you paid during the year. This statement should be sent to you by your lender by January 31st of each year. Make sure you have a copy of your most recent statement on hand before you begin calculating your tax-deductible mortgage interest. Step 3. Calculate your tax-deductible mortgage interest. To calculate your tax-deductible mortgage interest, simply multiply the total interest paid on your mortgage statement by the percentage of your mortgage that is tax-deductible. For example, if you paid $10,000 in mortgage interest and the mortgage is 80% tax-deductible, you would be able to deduct $8,000 from your taxable income. Step 4. Report your tax-deductible mortgage interest. Finally, report your tax-deductible mortgage interest on your tax return. You can claim the deduction on Schedule A of your Form 1040. Make sure to include all the necessary information and double-check your calculations before submitting your tax return to avoid errors and potential fines. Calculating your tax-deductible mortgage interest can be a simple process, but it's important to understand the eligibility requirements and to have all the necessary information on hand. By following the steps outlined in this guide, you'll be able to claim the maximum amount of mortgage interest you're eligible for and reduce your tax bill. At Wealthfinity, our goal is to help you build wealth and achieve financial independence. By taking advantage of all the tax deductions available to you, you can maximize your savings and reach your financial goals more quickly. In conclusion, deducting mortgage interest is a valuable tax benefit for homeowners. By understanding the guidelines set forth by the IRS, homeowners can effectively lower their tax bill by claiming mortgage interest on their tax returns. It's important to stay informed of any changes to the tax laws to ensure you are maximizing your savings. This complete guide to deducting mortgage interest has provided a comprehensive overview of the process and has equipped you with the necessary knowledge to take advantage of this tax benefit. Remember to always consult a tax professional for personalized advice.